If there's one type of investment I criticize all the time on this channel, it's mortgage REITs. That's because the vast majority of them experience poor long-term performance due to their risky investing strategies and the high amounts of leverage they employ. Whenever I do get on my soapbox about them, I always add a little disclaimer, which is that there are a couple exceptions that exist. Although nearly all the big names in this sector aren't very good, I always say that there are a couple that are good. So I thought we'd take a look at one of those exceptions. Unlike the vast majority of their peers, Rithm Capital is a company that's seen a lot of success following a serious transformation of their business. Unlike practically every other mortgage REIT out there, their stock has done significantly well in the last year. The share price of Rithm is currently up about 34% compared to a year ago, and that doesn't even account for the huge dividends it pays. And the reason for this, I think, has to do with how well this company's positioned themselves and how they've evolved over the years. So in today's video, we'll take a look at what makes this company so successful and why things continue to look really good for them. Rithm Capital, ticker RITM, is an asset manager that's focused on real estate, credit, and financial services. It operates through 4 segments, which are Origination and Servicing, Investment Portfolio, Mortgage Loans Receivable, and Asset Management segments. Their investment portfolio primarily comprises of mortgage servicing rights and MSR financing receivables. They also hold real estate securities, call rights, single-family rental properties, and consumer and business purpose loans. Whenever people look at the long-term performance of Rithm, they always see what I'd refer to as the cliff. In March of 2020, this company saw a drastic share price collapse as a result of the pandemic. In just 2 months, the share price of their stock fell by over 80%, and today it's still down more than 37% since February of 2020. With that in mind, many investors would probably not want to consider holding this company. Because sure, there were a lot of companies that saw their share prices fall hard during this time, but a lot of them have recovered since that event 4 years ago. But what investors should keep in mind is that Rithm Capital is nothing like they were during pre-pandemic times. The management team has been directing this company down a path that most mortgage REITs don't take. Before the pandemic, this company was known as New Residential. Back then, the company had 3 major focuses, which were investing in excess mortgage servicing rights, non-agency RMBSs, and agency RMBSs. But it was during the pandemic this company took a major hit when they were forced to sell a lot of their assets at a discount. This resulted in their share price taking a serious hit and their dividend being slashed significantly. But during the pandemic and even before the pandemic, New Residential was in the process of changing and diversifying their business. The company wanted to ensure that they could better perform under all economic environments, and as a result, they made some serious changes. One way they changed was by acquiring a diversified number of real estate-related companies. It's not extremely rare for MREITs to acquire other businesses. I just covered Ellington Financial, who recently acquired a mortgage lender. But Rithm Capital owns businesses that you don't normally see MREITs own, but they still fall under the real estate umbrella. For example, they acquired the company Adore, which is a company that owns more than 4,000 single-family rental properties. They also own a title insurance company, a property management company, a company that provides fix and flip loans, and 6 other businesses that fall within the real estate realm. If you listen to the management team talk on their earnings call, Rithm Capital seems determined to grow their business across every area of the real estate market. But as I'll go into later, I think this could actually serve as a threat to this company as an investment. But Rithm Capital also went through another really serious transformation in how they do business. In 2022, they went from being externally managed to internally managed. It was a big move that was expensive for them to perform, but in the long term it's worth it when looking at it from a cost savings perspective. Finally, one more way the company kinda moved in a new direction was focusing a lot more on mortgage servicing rights. Again, it's not uncommon for MREITs to hold MSRs, but for Rithm Capital, they make up a really sizable amount of their investment portfolio. MSRs are agreements that are set up by a mortgage lender to have a third-party company basically manage the mortgage on their behalf. The third-party company is responsible for collecting the payments from the borrower and performing other administrative services. So for example, a bank will issue out a mortgage to an individual and then give Rithm Capital the responsibility of collecting the payments and forwarding them on to the bank. And in exchange, the bank will pay Rithm Capital a certain amount for servicing the mortgage. So that's how this company's been transforming themselves, with the change in their name being the only bad part. So what's the result of them making these changes? Looking at their latest financial results, we can see they've continued to post really good metrics. The company reported earnings available for distribution of $247.4 million or 51 cents per diluted common share. As of the making of this video, their stock currently pays 25 cents per share per quarter, meaning that their dividend currently has a payout ratio of just 49%. This is probably the lowest payout ratio across all mortgage REITs and potentially the best among all REITs in general, as I don't recall seeing another company's dividend being so well covered. Also in their latest earnings call was an announcement regarding more share buybacks. It says, the company announced today that its board of directors authorized new stock repurchase programs of up to 200 million of shares in the company's common stock and up to 100 million of shares in the company's preferred stock through December 31st of 2024. The new repurchase programs replace the company's previous 200 million common stock repurchase program and 100 million preferred stock repurchase program, which expired on December 31st, 2023. Despite last year being a difficult year for REITs, and especially for M-REITs, Rithm reported really good financials for the year 2023. Their full-year earnings available for distribution came out to $2.06 per diluted common share. We saw a lot of M-REITs report terrible numbers last year, with a number of companies having to cut their dividends. But this company obviously stands out when it comes to their performance. Looking at their book value, which is one of the most important things to look at for an M-REIT, you'll see it's been very stable over the past couple years. The book value represents the value of an M-REIT's total investment portfolio. Most M-REITs out there have seen their book values collapse over the past couple years as the value of MBSs have plummeted with interest rates being so high. But because Rithm holds MSRs in other real estate companies, it's been a much steadier company. Even though things continue to be really good for this business, I do think there is kind of an unusual threat going on, not to the company but to Rithm stock. With the management team continuing to eye growth really aggressively, the company's CEO has stressed that he wants the company to grow as much as possible, and if that really is true, then Rithm Capital, in my opinion, won't be able to achieve that as long as they remain a mortgage REIT. Because M-REITs have to pay out most of their earnings to shareholders in the form of dividends, they don't get to retain as much to grow and expand their investment portfolios. It reminds me of a similar situation that took place with a business development company several years ago. Up until 2022, I was a big fan of a company called NewtekOne, who at the time were classified as a BDC. Just like Rithm, NewtekOne didn't really look like the typical company in their sector because they had diversified significantly over the years. In addition to providing capital to businesses, they expanded their services to include payroll processing, website security, e-commerce platforms, and employee benefits insurance. Again, sounds nothing like a typical BDC. In 2022, the company announced that they would no longer be classified as a business development company, as the management team wanted to pursue a different strategy. What followed was a significant dividend cut, and their share price hasn't been the same since then. Needless to say, what Rithm Capital's been doing has made me concerned they might try to convert to a C Corp or some other structure. There are benefits to staying as an M-REIT, with tax savings being the biggest in my opinion. As far as I know, nobody in the company has said anything about changing their business classification. But if it does happen, then it would happen completely out of nowhere, and Rithm could freely eliminate their dividend if they wanted to for the sake of pursuing aggressive growth. So this is probably my biggest concern about the company, apart from the usual concerns I might have about REITs right now, like how interest rates might remain higher for longer. But despite that concern, I continue to be a big fan of this company. It's extremely rare to come across a stock that's offering a 9% dividend yield that's so well covered. I'll also say that it is disappointing that they haven't increased their dividend or at least paid a special dividend in a very long time. But regardless, a 9% yield is still great, and when interest rates do get cut, then they could soar even higher. Rithm Capital, I think, is one of the best examples out there of a company that's corrected themselves and have transformed into something much better than they previously were. Let me know in the comments section what you think, but with that being said, that's going to conclude today's video. If you're interested, feel free to check out my Patreon, where you'll find an Excel sheet of all of my holdings updated monthly. Plus, it'll give you access to our Discord channel, where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.